The S&P 500 is one of the greatest wealth-building machines ever created, but the important question is not whether it is good. The important question is whether there are moments when a disciplined investor can do slightly better without confusing himself, overreaching, or taking risks he does not understand. That distinction matters because in investing, small differences become very large differences when they are repeated over long periods of time. Most people underestimate that they think wealth is created by finding one miracle investment, getting lucky, making one dramatic decision, or discovering the next company before everyone else. Sometimes that happens. But most durable wealth is created through a much simpler mechanism. You earn a slightly higher return. You avoid catastrophic mistakes. You keep adding money. You stay in the game long enough for compounding to do what compounding does. That is the whole machine. Let me show you why this matters. Imagine you have $10,000 today and you never invest another dollar again. If that money earns roughly 10% a year for 10 years, it grows to about $26,000. That is not bad. It is a good outcome. It is the kind of outcome that makes the S&P 500 one of the most useful investment tools for ordinary people. But now imagine you earn 13% instead of 10%. The same $10,000 becomes about $34,000 at 15%. It becomes about $40,000 at 17%. It becomes about $48,000. At first, a person may look at that and say, that is not enough to change my whole life. Why should I change my behavior for the difference between $26,000 and $48,000? That is because 10 years is not enough time to fully see the power of the difference. Now stretch the same example over 30 years. At 10%, $10,000 becomes roughly $174,000. At 13%, it becomes roughly $395,000. At 15%, it becomes roughly $662,000. At 17%, it becomes close to $1.1 million. The original $10,000 did not change. The time changed, the return changed, and because compounding is exponential, not linear, the result became completely different. This is one of the most important principles in markets and in life. Small advantages, when repeated long enough, produce results that look almost unbelievable to people who are thinking linearly. That is why the question of beating the S&P 500 matters, but it has to be approached carefully. A slightly higher return can create much more wealth. But the desire for a slightly higher return can also lead people into foolish concentration, emotional trading, expensive products, and strategies they do not really understand. So the goal is not to chase performance. The goal is to understand where the risk is coming from, where the return might come from, and whether the trade-off makes sense for your own situation. I want to be very clear about this. Anytime you try to earn more than the broad market, you are usually accepting more risk somewhere. That risk may be concentration risk, it may be volatility risk, it may be sector risk, it may be valuation risk. It may be the risk that the last decade's winner is not the next decade's winner. There is no free lunch, but there are rational ways to seek higher returns without acting like a gambler. That is what I want to focus on. The S&P 500 itself is simple. In concept, it is a group of the 500 largest companies in the U.S. stock market. When you buy an ETF that tracks it, such as a broad S&P 500 fund, you are not buying one company, you are buying a basket. You own a small piece of many large businesses. You own technology companies, consumer companies, industrial companies, healthcare companies, financial companies, and many others. If one company weakens badly enough that it no longer belongs among the strongest large companies, it can eventually leave the index and another company can take its place. That is one of the great strengths of an index. It has a natural replacement mechanism. It does not require you to sit there every day deciding whether one company is still good enough. The system does much of that work for you over the long run. The S&P 500 has represented a broad claim on American corporate productivity. It has survived wars, recessions, inflation, political crises, banking crises, oil shocks, bubbles, crashes, and long stretches of fear. That does not mean it goes up every year. It does not mean it is safe in the short term. It does not mean you cannot lose money. It means that if you understand the nature of the asset and you are able to hold through the cycle, it has historically rewarded long-term ownership of productive companies. That is why I do not criticize the S&P 500. I respect it. For many people, it should remain the core of their investing life. The danger begins when people hear that sentence and think it means they should never consider anything else. The economy is not static. Markets are not static. Sectors rise and fall. Technology changes. Governments spend money in different places. Capital flows toward certain industries and away from others. There are periods when certain groups of companies grow much faster than the broader market. The question is whether you can gain exposure to those groups through diversified funds rather than trying to pick one individual winner and hoping you guessed correctly. That is where certain ETFs become interesting. Not because they are magic, not because they guarantee outperformance, but because they allow a person to express a view about a sector, factor, or theme while still owning a basket rather than one fragile company. That is the difference between informed concentration and blind speculation. A single stock can fail because of one bad management team, one bad balance sheet, one lawsuit, one product failure, one accounting problem. One competitor or one regulation, an ETF can still fall. It can still underperform. But the risk is spread across a group of companies tied to the same idea that is a very different structure. Let us begin with growth. One way investors have tried to outperform the S&P 500 is by owning the growth companies inside or around the large cap universe rather than owning the whole index equally through every style. Growth companies are businesses whose revenues, earnings, or market opportunities are expanding faster than the average business. They often reinvest heavily, they often trade at higher valuations. They can do very well when capital is cheap, innovation is accelerating, and investors are willing to pay for future earnings. A growth-focused ETF gives exposure to that part of the market. The logic is simple. If the economy's biggest value creation is coming from companies that are scaling faster, building new platforms using technology, and expanding margins, then a fund tilted toward growth can outperform a broader index that also contains slower, moving value companies. Over the last decade, growth-focused large-cap ETFs have often produced returns that we're competitive with, and in many periods better than the broader S&P 500. But there is a trade-off. Growth does not only move upward faster, it can fall faster when expectations reset. When interest rates rise, investors discount future earnings more heavily. A company whose value depends on profits far out in the future can see its stock price compress, even if the company itself remains fundamentally strong. That is why growth investing requires emotional discipline. If you buy growth after it has already had a huge run and then sell it when it falls 30%, you are not using a strategy, you are reacting to pain. The right way to think about a growth ETF is not as a guaranteed upgrade over the S&P 500. It is a tilt. It says, I want more exposure to the companies that are likely to compound faster, and I accept that this may create more volatility. That is a rational idea for some investors and a bad idea for others. The second area is technology. A technology-focused ETF inside the S&P 500 or the large-cap universe gives you exposure to the companies that have driven an enormous share of wealth creation in recent years. Technology is not just a sector anymore in the old sense. It is the operating layer of the modern economy software. Semiconductors, cloud computing, cybersecurity, artificial intelligence, digital infrastructure, payments, enterprise systems, and data platforms are not small-side industries. They are increasingly embedded into how businesses operate. That is why technology funds such as broad large-cap tech ETFs have historically outperformed during periods when the digital economy was expanding rapidly. The logic is understandable. If the whole economy is becoming more digital, then the companies providing the digital infrastructure can grow faster than the average company. But again, there is a trade-off. When you buy a technology ETF, you are not buying the whole economy, you are buying a more concentrated slice of it. That means you can win more when that slice is leading, and you can suffer more when that slice is being repriced. This is how cycles work. People often forget that the best performing assets can also be the assets with the sharpest drawdowns. They see the return, but they do not see the emotional cost required to hold through the decline. If technology falls 25 or 35% in a bear market, that does not necessarily mean the thesis is broken. But if you did not understand the risk when you bought it, you will probably sell it exactly the wrong time. That is why I always come back to principles. Do not buy something only because it has gone up. Understand why it went up. Understand what would make it keep going up. Understand what could make it go down. Understand whether you can hold it when that happens. If you cannot hold the volatility, you do not really own the asset. The volatility owns you. The third area is aerospace and defense. This one makes some people uncomfortable, and I understand why defense investing has a moral dimension. It is tied to war, security, governments, weapons, aerospace systems, cybersecurity, satellites, and military infrastructure. Every person has to decide for himself whether that makes moral sense. I do not tell people what their moral compass should be. I separate the analysis into three parts. Does it make financial sense? Does it make legal sense? Does it make moral sense for you? All three matter from a financial point of view. Defense and aerospace can be interesting because government spending in that area is not driven only by consumer demand or ordinary business cycles. If a recession happens, people may buy fewer cars, fewer homes, fewer discretionary products. But if geopolitical risk is high, governments still spend on defense. Sometimes they spend more. That creates a different type of demand structure. It is not perfectly stable, but it is driven by forces that are not the same as the forces that drive ordinary consumer sectors. That is why defense ETFs have historically had periods of strong performance. They give investors exposure to companies involved in aircraft, missiles, satellites, defense electronics, cybersecurity, and national security infrastructure. The important point is not that defense is always good. No sector is always good. The important point is that it responds to a different set of drivers than the S&P 500 as a whole. That can make it useful in a portfolio if it fits your values and your risk framework. But do not confuse resilience with invincibility. Defense companies can still be overvalued. Contracts can be delayed, political priorities can change, margins can be pressured, a fund can still underperform. The principle is the same: understand the driver, understand the risk, Do not buy the headline. The fourth area is momentum. Momentum is one of the more interesting and psychologically difficult ideas in markets because it goes against what many people are taught. Many investors are told to buy low and sell high. That sounds sensible. But in practice, strong companies and strong sectors often keep going higher for longer than people expect because capital keeps flowing toward what is already working. Momentum strategies try to capture that effect. A momentum ETF might own the companies in the S&P 500 that have had the strongest price trends over a recent period. It does not try to predict the future from a story. It observes the current strength and rotates toward it. That can work well in markets where leadership persists. But it can also reverse sharply when leadership changes. Momentum is not value investing. It is not buying what looks cheap. It is not necessarily buying what looks comfortable. It is buying what is already moving because the evidence suggests that money is flowing there. This is very close to an institutional idea. Follow the money, but following the money requires humility because flows can reverse. When momentum breaks, it can break quickly if you do not have a process. You end up chasing the strongest thing at the top and abandoning it at the bottom. That is not momentum investing. That is crowd behavior. A momentum ETF can be a useful tool because it systematizes the process. It does not rely on your mood. It does not ask you what you feel like buying today. It follows a defined methodology. That is valuable because human beings are not naturally good at this. We chase when we are excited. We sell when we are afraid. We call emotion conviction when the price is rising, and we call panic prudence when the price is falling. A rules-based fund can reduce some of that emotional damage. Not all of it, but some of it. The fifth area is semiconductors. This is where the performance numbers in recent years have been extraordinary. Semiconductors are not just another technology category. They are the physical foundation of the digital economy. Your phone needs chips, your car needs chips, data centers need chips, artificial intelligence needs chips, medical devices need chips, defense systems need chips, industrial automation needs chips. Almost everything that becomes smarter, faster, more connected, or more automated needs more semiconductor capacity. That is why semiconductor ETFs such as SMH have dramatically outperformed many broad indexes over the last decade. They sit close to the bottleneck, and when a bottleneck becomes essential to the next technological cycle, the companies that control that bottleneck can become very powerful. But here again, the return is not free. Semiconductors are cyclical, they can be capital intensive, they can be exposed to inventory cycles. Export controls, geopolitical risk, Taiwan risk, competition, valuation compression, and demand shocks. A semiconductor ETF can do extremely well when the cycle is in its favor and fall sharply when expectations are too high. This is why I do not like the language of easy money. There is no easy money. There are only risks you understand and risks you do not understand. When a person buys a semiconductor ETF after seeing that it has compounded at more than twice the broad market, that person should ask a few questions. What drove that outperformance? Was it revenue growth, margin expansion, valuation expansion, AI demand, supply scarcity, or all of those things at once? Which of those forces can continue? Which can reverse? What happens if the sector falls 40%? Will I add, hold, or panic? If you cannot answer those questions, you are not investing in a theme. You are buying a feeling that is dangerous. Then there is the broad technology, heavy option, the Nasdaq 100. Often represented by QQQ. This is not exactly the same as a sector fund. It owns the 100 largest non-financial companies listed on the Nasdaq. Because of the structure of that market, it has heavy exposure to technology and growth-oriented companies. It has historically outperformed the S&P 500 over long periods. But it has also been more volatile. That is a very important point. When markets are rising, people love volatility because they experience it as upside. When markets are falling, they hate the same volatility because they experience it as loss, but it is the same feature. You cannot demand the upside of a more aggressive fund and then complain when the same aggressiveness works against you during a drawdown. A QQQ-type fund can be a powerful long-term tool for someone who believes that large, innovative companies will continue to dominate profit growth. But it is not a substitute for understanding risk. It is a sharper tool than the S&P 500. Sharper tools can build faster. They can also cut deeper. So after looking at these funds, the natural question is, what should a person actually do? And my answer is that the fund is not the whole strategy. The behavior is the strategy. Most people do not fail because they picked an imperfect ETF. They fail because they do not have a system for buying, holding, rebalancing, and surviving downturns. They buy when markets are hot because confidence feels high. They sell when markets go down because fear feels high. They call it risk management, but it is often just emotion management done badly. If you are going to invest in broad ETFs or more concentrated ETFs, you need a repeatable system. One simple system is always be buying. When markets rise, you buy. When markets fall, you buy. When the news is optimistic, you buy. When the news is frightening, you buy. Not because prices do not matter, but because human beings are bad at identifying the perfect moment. A disciplined schedule takes your ego out of the process. This is why automatic investing is so powerful. Money leaves your checking account on a regular schedule and goes into your portfolio. It happens whether there is a Republican president or a Democratic president. It happens whether inflation is high or low. It happens whether commentators are predicting a recession or celebrating a boom. The process continues because the process was designed before the emotion arrived. That is how good systems work. You do not create the rule in the middle of the panic. You create the rule before the panic so that when the panic comes, the rule protects you from yourself. And when markets fall significantly, if you have cash reserves and your life is financially stable. The second part of the system is to buy the dip. This does not mean throw every dollar into the market at once. It does not mean gamble. It means understand that market declines are part of the cycle and that good assets become cheaper when fear is highest. In 2022, the market fell sharply. In 2020, it fell even faster. In 2008, it was cut almost in half. These events felt terrible when they were happening. People said the system was broken. They said this time was different. They said it was safer to wait. But historically, those moments created enormous opportunities for people who had cash, discipline, and the emotional ability to buy when others were panicking. This is one of the great paradoxes of investing. The best prices usually come with the worst feelings. The worst prices often come with the best feelings. So if your strategy depends on feeling good before you buy, you will usually buy late. That is why cash reserves matter. Not because cash is a great long-term asset. It is not. Cash loses purchasing power over time. But cash gives you optionality. It gives you the ability to avoid selling in a downturn. It gives you the ability to buy when opportunities appear. It helps you stay psychologically stable when volatility rises. There is a balance. Too much cash becomes a drag. Too little cash turns every market decline into a personal emergency. The disciplined investor understands that liquidity is not the same as laziness. Liquidity is a tool. You need enough of it to survive and take advantage of stress, but not so much that inflation quietly destroys your purchasing power. This is the kind of thinking that matters more than any single ETF because an ETF is just a vehicle. Your behavior is the driver. If you put an impatient, emotional investor into a good ETF, he can still get a bad result. If you put a disciplined, patient investor into a reasonable strategy, he can get a very good result over time. That is why I always return to the same questions. What is the objective? What is the risk? What is the time horizon? What is the liquidity need? What will I do when the asset falls? What will I do when it rises too quickly? What rule keeps me from making a decision I will regret? Most people skip these questions. They want a ticker. But the ticker is the easiest part. The hard part is building a system that can survive your own emotions. Let us also be honest about the word outperform. Everyone wants to beat the S&P 500. Almost everyone underestimates how difficult that is. The S&P 500 is not a weak opponent. It is a very strong benchmark made up of some of the most profitable and adaptive companies in the world. Beating it over 1 year is not the same as beating it over 20 years. Many investors beat the market briefly and then give it all back because they confuse a favorable cycle with skill. That is why I do not think about outperformance as a promise. I think about it as a possibility that comes from accepting certain trade-offs. If you tilt toward growth, you may outperform when growth leads, but you may suffer when valuations compress. If you tilt toward technology, you may benefit from innovation, but you may suffer from concentration. If you tilt toward defense, you may benefit from geopolitical spending, but you must accept moral and policy considerations. If you tilt toward momentum, you may benefit from persistent flows, but you may suffer when leadership reverses. If you tilt toward semiconductors, you may benefit from AI and digital infrastructure, but you must accept cyclicality and geopolitical risk. If you tilt toward QQQ, you may benefit from large innovative companies, but you must tolerate higher volatility. There is no perfect answer. There is only the answer that fits your principles, your balance sheet, your risk tolerance, and your time horizon. For many people, the rational structure might be a core and satellite approach. The core is broad, diversified, and durable. That could be the S&P 500 total market funds or a balanced global allocation depending on the person. The satellites are smaller tilts toward areas where the investor believes there is a structural reason for higher growth or stronger capital flows. That approach prevents the investor from betting the whole future on one theme while still allowing him to seek more upside than the broad market alone. But even that must be sized correctly. If a satellite becomes too large, it is no longer a satellite, it is the portfolio. And if the portfolio becomes one big bet, then the investor has left the world of disciplined allocation and entered the world of speculation. The difference is not always the asset. The difference is the sizing. A risky asset in a small size can be rational. A good asset in an excessive size can become dangerous. This is another principle that people forget. Risk is not only what you own. Risk is how much you own, how you financed it, when you need the money, and whether you can hold through the cycle. The same ETF can be safe for one person and reckless for another. A 25-year-old investing monthly with a stable job and no need for the money for 30 years can tolerate a different level of volatility than a 65-year-old old who needs withdrawals next year. The asset did not change. The context changed, and context is everything. So when I look at these ETF examples, I do not see a shopping list. I see a map of possible tilts. Growth is a tilt toward faster expansion. Technology is a tilt toward digital infrastructure. Defense is a tilt toward government security spending. Momentum is a tilt toward current leadership. Semiconductors are a tilt toward the physical bottleneck of computing. QQQ is a broad tilt toward the largest non-financial innovators. Each has logic, each has risk, each can work, each can disappoint the investor. S job is not to worship any of them. The investor's job is to decide what role, if any, each one should play inside a coherent whole. That is how professionals think. They do not just say, what has gone up the most? They ask, why did it go up? What conditions would allow it to keep going up? What conditions would make it fail? And how much exposure do I want if I am wrong? That last question is the most important one. How much exposure do I want if I am wrong? Most people only size positions for the outcome they hope for. Professionals size for the outcome that hurts. That is why they survive. This is also why tax strategy matters, especially for business owners and higher income investors. A person can spend enormous energy trying to earn an extra 1 or 2% in the market while ignoring the money that leaks out through taxes, fees, bad account structure, and poor planning. That is a mistake. Investment return is not the only return that matters. After-tax return matters, net return matters, behavioral return matters. If you earn 15% but pay unnecessary taxes, unnecessary fees, and make poor timing decisions, your lived return may be far lower than the chart suggests. That is why good advice can be valuable when your situation becomes more complex. A bad advisor is expensive even if the fee looks cheap. A good advisor can help you avoid mistakes that do not show up until years later. But even here, the principle is the same. Do not outsource your thinking completely. Use advisors to improve your decision making, not replace your responsibility. No one will care about your money more than you do. So let me bring the whole thing together. The S&P 500 has been a remarkable wealth building asset for many people. It should remain the foundation. It gives broad exposure to the productive capacity of large American companies and has historically compounded well across many cycles. But there are funds that have beaten it over certain periods by concentrating in faster growing, more volatile, or more thematically powerful parts of the market. Growth ETFs have tilted toward companies expanding faster. Technology ETFs have captured the rise of the digital economy. Aerospace and defense ETFs have benefited from government security spending and geopolitical demand. Momentum ETFs have followed capital flows into current market leaders. Semiconductor ETFs have benefited from the chip cycle, AI, data centers, and the growing need for computing power. QQQ has captured the strength of the largest non-financial companies, many of them technology-driven. Those are the vehicles. But the real lesson is not simply which vehicle exists. The real lesson is that compounding rewards small advantages, but only when the investor survives the journey. If you chase performance without understanding risk, you may destroy the advantage if you panic during drawdowns. You may destroy the advantage if you concentrate too much. You may destroy the advantage if you buy only after everyone is excited. You may destroy the advantage. If you sell only after everyone is afraid, you may destroy the advantage. The market does not reward people simply because they found the right ticker. It rewards people who combine a reasonable asset with a durable process and enough emotional control to stay with it. That is why the most important part of the strategy is always the system. Always be buying if you have a long-term plan and the assets still fit that plan. Buy the dip if you have liquidity, discipline, and conviction grounded in research rather than emotion. Keep reserves so you are not forced to sell at the wrong time. Respect volatility instead of pretending it will not happen. Understand that recessions, market crashes, and painful drawdowns are not rare accidents. They are part of the machine over the last century. The market has experienced many recessions and many crashes. The people who treated those events as the end of the world often made poor decisions. The people who understood them as part of the cycle often used them to build wealth. That does not mean every dip should be bought blindly. It means the investor must be prepared before the dip comes. Preparation creates calm creates better decisions compound. That is the whole game. If you are trying to retire earlier, build more wealth, or outperform the broad market, do not begin by asking which ETF will make you rich fastest. Begin by asking what kind of investor you are building yourself into. Are you building a person who reacts to headlines, or are you building a person who follows a system? Are you building a person who buys what is popular, or are you building a person who understands why something has value? Are you building a person who panics when prices fall, or are you building a person who has cash conviction and a plan when fear creates discounts? Because the ETF can help you, the compound return can help you, the sector exposure can help you, but none of it can save you from yourself if you have no principles. That is why investing is not just about markets, it is about behavior under pressure. The person who can earn a slightly better return, keep adding money, avoid big mistakes, And stay disciplined for decades can end up in a completely different financial world than the person who simply reacts. That is how $10,000 can become $174,000, or $395,000, or $662,000, or more. Not because the first decision was dramatic, because the process was repeated, because time was allowed to work, because the investor understood the difference between risk and randomness, between volatility and danger, between opportunity and excitement. That is the lesson beating. The SP 500 is possible in certain periods. It is not guaranteed. It is not easy. It is not something you achieve by copying a ticker from a video and hoping the past repeats exactly. It is something you attempt carefully with sizing, diversification, discipline, and a willingness to keep learning. And if you cannot do that, the SP 500 itself is still a very good place to be. There is no shame in a simple strategy that works. The shame is in making a complicated strategy that fails because you did not understand it. So think in systems, build the core. Use tilts carefully, respect risk, keep buying through the cycle. And remember that the investor who stays disciplined during volatility often ends up owning the future that the emotional investor sold in fear.